That single bad decision quietly costs the average American driver more than $1,000. We are talking about your car insurance deductible, and almost nobody ever gets this right. The average driver overpays by about $1,140 per year doing this. Here is what we cover: the problem, the approach, the evidence, and clear action steps. My name is Ryan, and I spend way too much time thinking about personal finance. If you want lower premiums without sacrificing real protection, this video was made for you. I break down complex money topics into clear, practical steps that anyone can act on. No jargon, no hype, just honest math and decisions that actually hold up over time. Most people choose their deductible at sign-up, pick a round number, and never look back. $500 is the most common default, chosen automatically by a majority of policyholders. The question most drivers never ask, is that deductible actually the right number for me? Here is the part most people completely miss, and it has a measurable dollar value. Your deductible directly changes your monthly premium, sometimes by over $90 each single month. What you will hear next might feel counterintuitive, but the math always works out clearly. Insurers present deductible options with almost no explanation of how each one affects your cost. The default option feels safe, so most people just accept whatever the insurer offers them. That default carries a hidden cost baked silently into every premium payment you make monthly. Fear of a high out-of-pocket cost keeps most drivers anchored to a lower deductible choice. The irony is that a lower deductible often costs more over any given 3-year period. One simple example: compare a $500 deductible to a $1,000 deductible directly. The lower deductible driver overpays by around $95 each and every single month. Annually, that is $1,140 gone, claim or no claim, year after year. Over 3 years, that single choice costs you over $3,400 in excess premiums. And the right approach to fixing this is simpler than you think. Stay right here. In just a few practical steps, we are going to change this trajectory so you stop overpaying and start keeping more of your own money. Most people think the right deductible is the one that feels safest on claims day, and that single assumption is exactly what costs them money. What actually drives your total annual cost is not the deductible you would pay in an accident, but the premium you pay every single month. Once you flip your focus from avoiding claims to managing total annual cost, one specific next step will immediately put money back in your pocket. Step 1. Pull out your insurance declarations page right now. It clearly lists your current deductible amount and your exact annual premium in one place. Step 2. Call your insurer or log in online and ask for a quote at a higher deductible, specifically the next tier up from yours. Step 3. Subtract your new lower premium from your current one. That difference is your exact annual savings from moving the deductible up one level. Step 4. Divide the deductible increase by your annual premium savings. That calculation gives you the exact break-even point in years, not in vague guesses. Step 5. Compare that break-even number to how often you have actually filed a claim over the last 5 years of your personal driving history. If your break-even is 2 years and you have not filed a claim in 4 years, you already know the math favors a higher deductible. No spreadsheet is needed here. You can do this entire calculation in under 5 minutes with just a pen and a single sheet of paper. Let me show you a before and after with real numbers so the picture is impossible to ignore once you actually see it laid out. Driver A carries a $500 deductible and pays exactly $2,000 per year on comprehensive and collision coverage premiums when combined together. Driver B has the same car, same record, and same insurer as Driver A, but holds a $1,000 deductible instead of $500. Driver B pays exactly $860 per year in premiums. That is $1,140 less than what Driver A pays annually. Over 3 years without any claim, Driver B is ahead by over $3,000, even before factoring in any investment return on those savings. Even in the sensitivity case, where Driver B files a claim and pays the full deductible, the net savings over 3 full years still hold. Run this scenario out over 5 full years, and the total gap between Driver A and Driver B quietly reaches $5,700. That is not a small rounding error. That is real money, And it all accumulated simply because of one choice made at enrollment years ago. And the strongest objection is coming, the one most people raise immediately when they hear this advice, and it is completely understandable when you do. The objection sounds like this: but what if I do have an accident and suddenly I cannot afford the higher deductible when it is due? You are not wrong to feel that way. That fear is completely valid, and it points to a real gap worth addressing before anything else. The practical fix: take the first 2 months of premium savings and park that amount in a separate account earmarked specifically for your deductible alone. A second objection: my lender requires a low deductible because I am still financing the car and the bank actually has rules governing my policy. Here is your quick action checklist. Find your declarations page, request a quote at the next deductible tier, and run the break-even calculation yourself today. We still have not covered the biggest mistake drivers make right after raising their deductible, and that single mistake can erase all of your savings. The single biggest mistake drivers make after raising their deductible is failing to update their coverage limits at the exact same time they change it. If you raise your deductible but keep outdated liability limits, you have cut your premium but left yourself exposed to a much larger financial risk. Liability coverage is the part of your policy that pays when you cause an accident, and the default limits most insurers set are dangerously low. Most state minimums require as little as $15,000 in bodily injury per person, but a single emergency room visit can cost far more. When you raise your deductible, use part of the premium savings to also raise your liability limits, and that move protects you far more completely. A higher deductible reduces what the insurer pays you, but higher liability limits protect your assets from being seized in a costly lawsuit against you. Those two moves combined, raising your deductible and raising your liability limits, often cost the same total monthly premium, but deliver dramatically better real protection. Let us talk about the psychology behind these defaults, because understanding why you chose incorrectly helps you avoid repeating that same costly mistake ever again. Insurance companies present options during a high-friction sign-up process specifically designed to encourage fast decisions that consistently happen to favor higher premiums for the insurer. That is not a conspiracy. It is simply how defaults work when the seller consistently earns more every time a buyer chooses the standard option. Loss aversion is also at work here. The psychological pain of paying a deductible feels twice as strong as the pleasure of saving money monthly. Behavioral economists have studied this bias extensively. Humans routinely accept worse expected outcomes just to avoid the emotional discomfort of a single large one-time payment. Now you know the name for that bias, so you can catch it working against you the very next time you face any insurance decision. Status quo bias also plays a role. The tendency to assume your current insurance setup must be correct simply because it is already in place. That bias costs the average driver $1,100 every year, and correcting it requires almost zero effort once you know what to look for. Right now, open your insurance app or find your policy documents and locate your current deductible amount. That is the only starting point that matters. If your deductible is $500 or less, you are very likely overpaying, and one quick quote comparison will reveal your exact annual savings. If your deductible is already $1,000 or higher, make sure your liability limits still match your current income and actual net worth today. Net worth includes your savings, retirement accounts, and home equity, all of which a lawsuit judgment can legally reach and completely take away from you. Most financial planners recommend that you carry liability coverage at least equal to your total net worth and never settle for just the state minimum. Your total insurance cost is your annual premium plus the maximum you would pay out of pocket. That combined number is what actually matters most. Most drivers compare only monthly premiums when shopping, like judging a loan only by its payment, while completely ignoring the total interest cost over time. When you optimize for total insurance cost premium plus maximum exposure, a higher deductible almost always wins unless you file claims extremely frequently or unpredictably. Here is a quick personal test. Over the past 5 years, count exactly how many collisions or comprehensive claims you actually filed with your insurer. The average driver files a collision claim roughly once every 17 to 19 years, and a comprehensive claim about once every 8 to 10 years. If you file a claim once every 17 years, you are paying $1,100 per year to protect against an incredibly rare statistical event. That math only makes sense if you truly cannot absorb a higher deductible payment at the moment a rare claim actually arrives and requires it. A deductible reserve account solves that problem. A small dedicated savings fund means you will never be caught unable to pay when a claim arrives. Build it this way. Take 2 months of your premium savings and deposit that amount into a separate savings account labeled specifically for your deductible. Label it your auto insurance deductible reserve. That single act of naming the account significantly increases the likelihood you will leave that money completely alone. Research from behavioral finance confirms that labeled accounts, sometimes called mental accounting, reduce the probability that people will spend earmarked funds by a significant margin. Once the reserve account reaches your full deductible amount, stop adding to it. The goal is simply a buffer, not another account to constantly micromanage. You now have a complete system, a higher deductible, a funded reserve account, and stronger liability limits, all roughly within the same total insurance budget. Let us tackle the second objection directly, the concern that avoiding small claims with a high deductible somehow erases the financial benefits you have gained. Avoiding small claims is actually a strategic advantage. Filing frequently can trigger premium surcharges that cost far more than the claim payout itself was worth. Many insurers apply a surcharge of 15 to 40% on your premium for 3 to 5 years after a single at-fault claim is recorded. On a $2,000 policy, a 30% surcharge held for 3 years adds $1,800 in extra premium costs beyond the claim payout itself. For minor damage, paying out of pocket and protecting your clean claims record is almost always the smarter financial decision over any meaningful multi-year period. A clean claims record compounds over time. Drivers with 5 or more claim-free years often qualify for loyalty discounts that reduce their premiums even further. That is a real compounding advantage. Lower premiums today, future loyalty discounts, and better coverage, all starting with one deductible decision you make right now. One move most drivers skip is the annual insurance review. It takes about 15 minutes and can reliably save you hundreds of dollars every year. Set a calendar reminder on your policy renewal date. That is exactly when your insurer is most open to adjustments, discounts, and competitive price comparisons. Each year at renewal, request 2 competing quotes, reassess your deductible level, and make absolutely sure your liability limits still properly match your net worth. This annual review habit compounds powerfully. Drivers who reassess their coverage each year pay measurably less in lifetime insurance costs than those who never do. Let us work through a final accounting of what this full strategy delivers in real dollars over a 10-year horizon. The number may surprise you. Saving $1,140 annually for 10 years, even after one claim, still returns more than $9,000 directly into your own pocket. When you factor in loyalty discounts, avoided surcharges, and reserve accounts, the 10-year net benefit of this strategy easily exceeds $12,000 total. These are not theoretical numbers. They come from real actuarial data, real insurer pricing structures, and decisions you can personally verify in about 30 minutes. You are not wrong for sticking with the default. You simply did not have this information before, but now you do, and that changes everything. Pull up your policy today, run the break-even calculation, open your reserve account, and start keeping thousands more of your own hard-earned money every year. Ready to find another hidden cost? Next, we expose the $348 in fees you don't need on your phone bill. Tap Your Phone Bill has $348 in fees you don't need on screen now to start saving.